Welcome, and thank you for joining us both here in the room and online. Increasing inequality is a defining issue of our time. I was reminded of these words by Barack Obama in a speech in 2013 when preparing for this session, not only because I thought that's a good way to get your attention to begin with, but also because it kind of brought this issue into mainstream politics. 10 years has passed, and I propose to you that inequality still very much is a defining issue of our time, also for mainstream investors. So my name is Nikolaj Petersen. I'm the lead at the PRI on human rights and social issues, and I'm delighted to guide us through this discussion today. 2013 was also the year when the French economist Thomas Piketty released the book Capital in the 21st Century, where he went through the historical relationship between capital and economic growth and the impacts that had on wealth and income inequality. And once again, I think this is a moment where the topic of inequality became part of the public debate, and I would say rarely has an academic book been so widely quoted, probably also by people who had not opened the book. And I hope our academic speaker here, Todd, is not going to reveal me in this instance, but that gives me an opportunity to introduce our first speaker, Todd Court, who's a professor at the Yale Center for Business and Environment and a thought leader on socioeconomic inequality and the related macroeconomic impacts. And we're going to hear very shortly from Todd, who's going to give a bit of a global outlook for us. In the SDGs, which we've had since 2015, in a way our global roadmap to sustainable development, we find Goal 10, which has the stated aim to reduce inequality within and among countries. So I've set a bit of context here with some developments that dates back 10 years, but still, according to Oxfam research earlier this year, the 5 richest men have doubled their wealth since 2020, a period in which the 5 billion poorest people have gotten poorer. And I'm delighted we have Oxfam represented today with Sharan Contractor, who is a lead for investor engagement and advocacy at Oxfam America. She's also one of the people behind Oxfam's corporate inequality framework and a recent study on the impacts of US corporates on inequality, and we'll hear more on that as well in this panel. Next, it's worth noting for context the launch of the Taskforce for Inequality and Social-Related Financial Disclosure, which happened just a few weeks ago. And we also have represented, she's joining us online, Sharan Burrow, who is the newly elected co-chair of TISFD and the former General Secretary of the International Trade Union Confederation, a position she held for more than 10 years. So I'm really looking forward to hearing her perspectives. And lastly, to discuss these issues and the relevance for our industry, the investment industry, I'm delighted to welcome also Lebogang Mokabudi, who is an independent board trustee on the Government Employee Pension Fund in South Africa. And I do believe it's the largest pension fund in Africa, if I'm not mistaken. And Lebo is also a PRI board member and holds multiple other board roles across the continent. And lastly, not least, we have Sindhu Yanakiram, Equality Lead at BNP Paribas Asset Management, one of the largest asset managers in Europe. And Sindhu manages strategy and research on all social topics and is the lead author behind the firm's new roadmap to address inequality, which is also fresh off the press. So a lot of fresh content for us today on this panel. But before we turn to our speakers, I'd like to involve also you in our audience. We have a few questions for you. So if you turn now to the app on your mobile phones, you'll find the first question. And we ask you, how does your organization view economic inequality in an investment context? This is predominantly for our investors in the audience, perhaps also if you're doing research or consultancy advice or the like. We ask that you give us your input on this question. And while we give our audience a bit of time just to respond to this, perhaps Sindhu, we can, without spoiling your remarks later, just ask at a high level how BNP Paribas would look at this.
First of all, thank you for having me. It's great to be here, and I love the first poll responses here. Oh, okay, it's moving. We absolutely consider it a material investment. material issue for our investment process. So with the launch of this roadmap, which we launched on October 1st, I would encourage you to check it out on our website. We factor inequality risk into our investment process, into how we control risk, into our own operations, into a variety of different ways all across our business. And our roadmap kind of dives into how we measure inequality risk, how we tie it to inequality outcomes, and kind of develops a new framework, a novel framework for mapping inequality outcomes, which I know Todd and Charmaine are going to talk about, to corporate activity itself, and the role investors can play in doing that.
So really the first two responses resonate with the organization.
Absolutely.
The systemic risk factor and the company level risk. So that's encouraging. Let's we take note of that, and we'll get into it much more in the discussion. But let's move on to the second question, and you'll find it again in your app on the phone. And now we ask you, what challenges do you face in responding to economic inequality? And you can think of this anything from internal organizational aspects or external factors like regulation and the like. And perhaps again, while we wait, Lebo, if you wouldn't mind sharing with us perhaps your top challenge as it comes to inequality.
Pleasure to be here. Thank you for having me. So I think I'll start with setting the context in South Africa with regards to economic inequality. So in South Africa, we have large inequality where 10% of the population own the wealth, and 80% are impoverished, or 80% have unemployment challenges in South Africa. One of my colleagues yesterday from Old Mutual also shared how economic inequality has also caused unemployment. We have, one of the largest unemployment rates in the world in South Africa. Apartheid, post-apartheid has caused social spatial planning and exclusion, where a large majority live far from economic opportunities, which further, adds to the unemployment rates in South Africa and access to employment opportunities, economic opportunities, as well as capital creation opportunities. And lastly, I'll also talk about access to finance. I think that's one of the biggest challenges in South Africa for the large majority: access to finance, access to credit, to build a house, access to credit to grow your business, access to credit to go to university, and all those access to affordable financial services, of course, increase economic inequality in our country. But lastly, which is relevant to this room, is also access to capital for asset managers, and capital allocation that goes to African asset managers is one of the other challenges that we face and that we address as the government employees pension fund in South Africa.
Thank you, Lebo. And I see a few issues that we've discussed also in our preparation work. Data in the center, as it often is, where to start, lack of resources, lack of incentives. We'll get into a lot of this in our discussion. But without wasting any further time, I'd like to hand over to Todd to share his outlook and give a bit of a global perspective on the macroeconomics.
Hello, everybody. It's a real honor to be here. So I think my role is to present, kind of set the table a little bit and give you an analysis of the macroeconomic conditions that socioeconomic inequality brings to businesses and governments. And then we can kind of bring in the practitioners about the realities of how to address this. So this is based on a paper that's a couple of years old with two co-authors, Stefan Park from the University of Connecticut and Decio Nascimento from Norbury Partners. And the basic premise of the paper is to look at all the macroeconomic theories and data that is present, arguing for either increased GDP and productivity as a result of inequality versus a drag on GDP and inequality as a result of inequality. Because as those of you who read the literature, both of these factors are presented by economists around the world. So I want to this is the summary of all the factors that we see in the economic world that socioeconomic inequality creates. And I'll walk through them a little quickly because I don't want to take all of my time. So on the GDP side, there's three arguments that economic inequality will increase GDP and national outcomes. So the first is around savings rates. The argument here is that if you concentrate wealth to a smaller group, then you create more disposable income compared to subsistence income. And that higher level of disposable income is the investable income that will then go into the economy in terms of building resilience and innovation. I put small arrows on these on purpose because the evidence for these three kind of increasing factors is much, much less substantial than the large arrows about drag. The second argument for increasing GDP as a result of economic inequality is the indivisibility of investments. The argument being that the greatest investments to build GDP require large amounts of capital, and those are indivisible, meaning you need big pools of capital in order to do it, and so you have to concentrate wealth among a small amount of actors that can create that kind of capital pool. And the third is called the moral hazard. Essentially, the moral hazard is that if you put in policies to transfer wealth from the wealthy to the less wealthy, that disincentivizes people from building wealth in the first place. So you create a moral hazard to people who would become the wealthy class through those redistributed policies. So those are the arguments that GDP would increase as a result of inequality. However, there's the three predominant factors on GDP are all drags. So the first, which was already mentioned, is the access to credit markets. So this argument is that if you reduce the amount of access to credit markets, then an investor or an entrepreneur or a business, someone who wants to start a business, they would be unable to create resilience within their economy because they cannot access low cost of capital. There's a continuum here, of course. If you have low cost of capital in credit markets, then you can create much more resilience per dollar invested. If you're paying 25 to 80% interest rates on that credit, then it's very, very difficult to create that same resilience. So it's not just access, it's access to low cost of capital credit markets that creates the greatest drag. Education investment is a second. If people that do not have means cannot invest in education, then we see generational disparities, and the next generation is much, much, much less likely to invest into economic productivity. And then finally, the flip side of investment indivisibility is consumption indivisibility. So this argument is that in order to build economic productivity within your nation, there are actually large purchases that need to be made. So people have to buy high margin goods in order to create a lot of economic GDP growth. And if you do not have a wide base of people that can buy those products, then you can't create the products at scale and at margin. So overall, the evidence suggests that GDP is dragged down substantially by socioeconomic inequality. The second factor, which sits underneath GDP, is employee productivity. And this is really that in the face of socioeconomic inequality, there's a lack of healthcare systems, education systems, financial infrastructure systems, credit markets. All of these are depleted when socioeconomic inequality is high, and that results in a substantial reduction in employee productivity. You can imagine your employee, they've got a lot of other things to do. If they don't have the means, they can't commit to their work. They've got to go home. They've got to take care of the family. They've got to take care of the kids, and productivity can go down substantially. The third is political stability. This is an indirect consequence to GDP, but there's three factors that also drag down political stability from inequality. So the first is corruption. This is a little counterintuitive, but the evidence is fairly clear that when in an unequal society, the population will tend to elect leaders that will put redistributed policies in place, meaning we want someone that will transfer money from the wealthy to the poor because we have substantial inequality. The result, historically, has been that the wealthy leaders within those countries are heavily incentivized to develop corrupt practices to prevent that wealth redistribution within the country, as opposed to a successful wealth redistribution. So we see in these in these circumstances that we have increased instability, political instability, because of the rise of systemic corruption within those countries. Crime is fairly self-explanatory in more unequal societies, and that is always a drag on GDP. It's also a drag on political stability. We can see that to our neighbor just to the south at the moment. And then, that's me, by the way, I'm a US And then finally, there's a lower opportunity cost for violence and disruption. If you really have nothing that you're working towards, there's very, very little opportunity cost for you to be disrupted to an economy or to the political situation. So overall, socioeconomic inequality appears to have a substantial drag on the systems that we rely on for economic productivity. All right, so couple of quick slides. So this is just a representation. These are your companies, these little dots within the national and regional economy. So we have these drags because of inequality. However, it's very difficult to measure the amount of drag that we have because of the push from governments to create social safety nets. So these include housing, healthcare, job training, food, education. These are usually funded by taxes as well as import levies and tariffs. But the government can have an enormous effect to buffer the companies within the economy from those drags. And therefore, it's sometimes very difficult for us to understand the extent of the drag that we see on individual companies within these economies because of that social safety net. It's not like other ESG risks where the company is more directly exposed. But regardless of those safety nets, or in some cases because of those safety nets, what we're seeing is that socioeconomic inequality is probably the next global mega risk for companies. So climate change was the leading wave. Now we're seeing the collapse of ecosystems. Socioeconomic inequality is probably going to be as substantial or more substantial than those first two. Obviously, they're all tied together. There's a few reasons for that. So the first is that those social safety nets that have historically buffered companies from the consequences of inequality, those have been hiding the amount of risk that we're actually facing. Those nets are increasingly eroding around the world, and predominantly in very unequal societies, they're focused almost entirely on the extremely poor, as opposed to anyone under a living wage or a substantial wage. And so those social safety nets are starting to evaporate under the feet of companies in these countries. And finally, the inequality rates are rising globally. I think we've seen that data fairly substantially. So we've got rising inequality, eroding social safety nets. All these companies within these national economies, that ground is starting to erode underneath them. We expect that the risk is going to start to manifest more and more. The final note here is that normally when we think of socioeconomic equality, we think of systemic risk, right? GDP, employee productivity. These are systemic risks. The entire economy is dragged down. But increasingly we're seeing idiosyncratic exposures. I won't walk through any of these, but it's worth noting that if you're a portfolio manager, some companies within your portfolio are going to be more exposed to socioeconomic inequality risk than others because of things like reputational benefit from their social responsibility efforts. Those are going to be diminished because they can no longer meet the need of the communities that they're trying to serve. They're more exposed to skilled workers. Those skilled workers are no longer being educated. They depend on high capex investments. There's no longer substantial capital allocated or available within the economy. So I'll leave you on that note. I want to hand over back to our host and take any questions.
Thanks very much, Todd. A bit of a tour de force there in some of the impacts that we're facing. So perhaps I just, without any further delay, ask you, Cinder, you touched a bit on it when we did a bit of talk during the survey, but how do you deal with these many issues?
Well, a lot of what Todd was just talking about is very resonant with us because we do view inequality as the next mega risk, as you framed it. The 3 E's that we talk about in our BNPAM sustainability strategy are a successful energy transition, healthy ecosystems, and greater equality in our society. So that really matches up with how we're thinking about it. And we're also thinking about inequality in both a systemic risk way and an idiosyncratic risk way. Systemic risk for all of the reasons Todd just talked about. It limits economic growth. It exacerbates financial vulnerabilities in our system. This is something that both the Intergovernmental Panel on Climate Change, IPCC, and the US Federal Reserve are saying are systemic risks that pose risks to our market system. But I think the interesting thing is how to measure that risk in the idiosyncratic way. And that's where we're starting to do that framework I mentioned of matching inequality outcomes with business functions, with wages and board composition, but also access and affordability and externalities of products and services. And with better data, I saw in the first poll that one of the main issues was data. And I know we have data providers in here. Data is a key part of our solution of measuring inequality in a holistic way and evolving our understanding of how to measure inequality outcomes and therefore develop products and solutions and use ESG integration to help solve inequality outcomes.
And since we're on the point of data and it was raised as a challenge, can I maybe ask a follow-up? What, any views on the data we have available now?
Yeah, I mean, the context for data is that it's much easier, relatively speaking, to measure GHG emissions and trace the causes and consequences of climate change with quantitative emissions data versus social data that is much more complex, depends on patchwork regulations and cultural contexts that are very different. But just because social issues are more complex and harder to measure doesn't make them any less material. That's our position, at least. And so, we've onboarded new data providers that seek to kind of fill in the gaps, let's say on gender equality. So we take it as the first step to measure the number of women on the board, let's say in a given issuer. But now we want to look at women in senior management. We want to look at the employee ladder to understand the inequality outcomes there. We want to look at tax avoidance. We want to look at the wage gap. And so with tools like machine learning and natural language processing, we can bridge that gap on data, on social data. We've started to do that to get better insight into corporate contributions to inequality.
Interesting. And Lebo, we had a bit of a taste for some of the particular issues in South Africa earlier, but do you care to elaborate and on some of the issues Todd has raised for us here? How are you facing those?
Okay, happy to. I've already shared the challenges, and I think that's been exhausted already in terms of what are the economic challenges, and I resonate definitely with the data that was shared by Todd. And I think it's access to finance. You've rightfully said access to finance is an issue, and access to capital, right? Capital opportunities and access to capital for African asset owners and asset managers, as an example. But I think also access to services and quality services. So access to quality education, quality healthcare, and access to housing is a big challenge. But to spin that, we see them as investment opportunities. I think as a globe, as a world, as a continent, and as a country, we speak about these things as social issues and challenges that governments, should solve. But now it's turning that on its head and seeing them as investment opportunities, and that's what we're doing now. We've incorporated that into our transformation policies and as well as into our development investment policies as investment opportunities for asset managers to actually access those investment opportunities, invest in quality healthcare funds, invest in funds that focus on access to education, healthcare, etc. So that's what we're doing and influencing our asset managers and the influence that we have in South Africa as well as the rest of the continent.
Interesting. You mentioned housing because I was speaking to a lady yesterday during lunch, saying that this is an issue that features on television pretty much on a daily basis here in Canada, and I think in most major cities we do have a housing crisis, which very strongly relates to some of the issues on inequality that we've discussed. Just another question for you, Sindhu. We've sort of touched a little bit on some different asset classes here. How do you approach this, and let's say outside of equities?
Fixed income is where a lot of inroads can be made. You can have use of proceeds that are tied to inequality outcomes, to better housing, to more hospital beds. We have strategies that do that. So I think this is a cross-asset class, cross-industry approach. I think to the earlier point, determining which industries, which sectors, which regions have greater or lesser contributions to inequality outcomes is what we need the better data for. That's been said before, we don't have a Paris Agreement on inequality. So I think we're at the very beginning with the launch of TISFD, with Sharan obviously leading. With our roadmap coming out and a lot of other wind at our backs on this issue, that we're at the beginning of this process. Now, going forward, let's say next year, the year after that, can we develop better strategies, more acute strategies that across different asset classes are improving inequality outcomes? And that starts with better assessment.
Yeah, interesting. And I noticed one of the challenges that someone mentioned was also perhaps the conflict sometimes between inequality and the impacts, and then financial incentives, the financial outcomes. And perhaps that's something we need to grapple with. There might be benefits from certain investments, narrowly speaking, but perhaps we're aggregating some of the issues. So just like on climate, we have to come to terms with that and understand how that plays out. I'd like to take some questions from the audience, and I do realize I should have an iPad here where I can see what's coming in, so if someone can please bring that. But I think we also have mics. If someone has any questions. Thank you.
Can I make a comment on the investability?
Todd, please buy me some time.
While you set up. It's interesting. So Lebo mentioned how we're trying to flip the script, right? It's building these access to systems and services is a cost that governments have to bear at the moment. But can we flip the script and say these are profitable investments? One of the biggest hurdles to that, which I think you guys know more than I do about, is that cost of credit, that cost of debt in these societies where those systems don't exist is incredibly high. Right? The lending rates are in the high teens up into the 20, 30, 40%. It's very difficult to make a profitable investment when the cost of that capital is so high. But there's increasing evidence, probably amongst the room here, that risk is completely mispriced in those markets. That we're using actuarial data to suggest that, because there's no healthcare system, that company has an enormous risk of defaulting against their debt because their employees won't be able to work in the future, or with the next climate event, they won't be able to recover sufficiently. But the entrepreneurs, the companies that are building resilience through building that healthcare or that education system are actually improving the credit worthiness of the investment. So it's a bit of a cart and horse argument, but there's really good data that we are mispricing the investments into those assets. And if we can create sufficient data to show that mispricing, we can really speed up that flow of capital to make these profitable investments.
Very interesting insight. And we're back online here as well, so if you have questions, please send them through. The gentleman here also has a question, I see.
Well, thank you for your great comments. My name is Douglas Beal. I'm with Boston Consulting Group, and I lead our work on the S side of ESG, and also this just transition concept. And about 2 years ago, I think I realized, and many of our clients realized, that they had been spending so much time and budget figuring out climate, and they had top-down models on how do we sort out climate, what our carbon footprint is, but the social side of things was completely fragmented within the institution. And most of my clients are financial institutions. So when I started speaking with many of them about sorting out the social side, a lot of them have said, "Hey, Doug, great idea, but the only way to get traction on this is to link it to climate progress." And so I was like, okay, I'm gonna have to do that. So I think Sindhu was in the BCG office 2 weeks ago. We had an event on just transition. And so part of what I am trying to do is integrate the two together and have a lot of the models that GFANs and that some of the regulators are creating, some of these targets start to integrate social considerations in. So Sindhu, you mentioned, when an issuer issues a bond, it's not just a social bond, but a green bond that then integrates social considerations into it. So I'd love to hear from any of you about what you think the importance is of linking to climate progress and how you think about it, or is inequality or human rights or many of the other social issues we're all concerned about something that can be kind of dealt with as a standalone topic? Thank you.
Thank you. That's a great question. Shamin, may I hand this one to you, because I know you released a report quite recently with the Rights Collab
Yes.
out of New York, where one of the things you talk about is the interlinkages.
Yes, we just actually last month released a report that really talks about the systemic risk and links, the like what you talk about in the different issues of inequality. And over there, we talk very, very deliberately about climate change and the impacts of climate change on inequality. You cannot, I don't think you can deal with any of these in isolation from what our report talks about, and even, some of the data that I'm going into now in my presentation. I think it's very important to look at all of these together. And I think that's also what we notice at Oxfam is the problem is that for decades, a lot of folks or a lot of, different stakeholders have been looking at this entirely differently. And, that's also what the problem we see, like the climate crisis, for example, or climate change to some extent is also responsible for the rise of for example, the far right and the far left that we see in so many different countries, especially in the US, like 2016, in so many of the Rust Belt states, we saw that they felt excluded, from talking about climate change, from the Paris Agreement, from US's contribution into that. And they're like, what about us? How are you thinking about us? How are we going to transition? So I think I don't know if I'm answering your question, but I think it's very important to look at all of these issues together.
I think it's a very good point on the context, but perhaps there's also an organizational aspect here, as he said about, organizations might be set up in their ESG teams with higher degree of sophistication on the climate side. They have built models. And some of the people in the room here may not have the luxury of just focusing on one issue, like social issues. So how do you have 3 roadmaps, Sindhu, at BNP Paribas, mega issues. How do you sort of make that operational? How do you implement that?
No, I think what's great about our global sustainability center that we have, it's a center of excellence, is that we have a climate lead, we have a biodiversity lead, and we have me as an equality lead, and we all work together. Issues like just transition are obviously an overlap between that climate work and my social work, and it's elevated within our team. It is a fact that we're within the investment team itself. We're not in the back office, right? That work is elevated and integrated. We have a model where portfolio managers on our team are what are called ESG champions, where they're given a lot of, they're empowered basically to take sustainability insights from our team and integrate it into their investment process. We work really closely with them. But I just want to go back to this kind of idea of the linkages there. We call it the double bind in our roadmap, which is that the IPC says in their 6th assessment report that inequality and climate change exacerbate one another. And they go into great detail. They spend a lot of time in this very important scientific research of the 6th assessment report talking about inequality. That's not a coincidence. At the same time, the kind of response to inequality must integrate inequality, or the response to climate change must integrate inequality considerations. Otherwise, you risk a backlash. So we saw this with the Yellow Vest protests in 2018, and we saw it this spring with the farmer protests against the common agricultural policy of the EU. And so you need that just transition element. I'm encouraged that, for example, Climate Action 100 Plus has just transition as part of their disclosure indicators. I think we need to do a little bit more on developing methodologies that the entire industry gets behind to measure social risks as part of the transition. But it is absolutely inexorably linked with our ability to solve climate change. And we haven't talked about biodiversity, but impact on indigenous populations, our ability to kind of manage biodiversity programs and nature loss with an inequality consideration is equally important as well.
So even if it's tempting to sort of go a little bit tunnel vision on a certain issue, it's going to come back to bite us. We need a holistic approach. You need a holistic approach because the issues are linked, and your ability to solve one is strengthened by your ability to solve the other, and the opposite is true. Very good. Please do send in questions. We'll come back to them. But I would like to hand over to Shamin now to walk us through the Oxfam framework. I think it gets us a little bit more into this as well, on the linkages between the issues at the company level.
All right, I'm just going to start. Thank you so much for inviting Oxfam to speak about our corporate inequality framework. But before we dive into it, I'm going to talk about what was the motivation behind this. So it's in Oxfam's work over decades across the globe, we have noticed the widening gap between the wealthy and the poor, between corporate executives and workers. This is only getting bigger. What we noticed is that this hurts the collective ability of most people to meet the needs of their families, support communities, and to improve the quality of living. The largest corporations in the US, we've noticed, and I'm sure that is not surprising to you, play an outsized role in the inequality crisis, not only in the country, but across the globe. As investors, we are hoping that many of you can play a critical role in holding companies to account that can not only derive positive returns, but also create positive impact. In the slides now, I'll present our framework along with an accompanying data set developed precisely to evaluate and to show you the extent of corporate malfeasance and the risks that if business continue down this path. So at Oxfam, we've created this framework to help various stakeholders, including investors and policymakers, really understand and analyze how corporations, particularly multinational companies, are fueling the inequality crisis. We're calling it that, the crisis. So we pilot tested this framework against 200 of some of the largest publicly traded companies in the US, as well as 10 top private companies by revenue. So our findings clearly show that corporations are exacerbating inequality. Looking at these companies together, what we noticed is that their impacts can reverberate across the economy and grow to become systemic risk. So our research is grounded, I should say, on 4 pillars, which we identified as people, power, profits, and the planet. So under each of these categorizing pillars, we assess corporate inequality across 15 subtopics and approximately 80 corresponding indicators. The factors that include company behavior and activity relate to working conditions, pay equity, collective bargaining, board diversity, political contributions, climate actions, and much more. We assessed individual companies' inequality footprint at 4 different levels. We looked at disclosure, which talks about transparency in reporting, policy, which looks at companies' public commitments, performance, looking at their internal management practices, metrics and KPIs, and how they violate relevant standards, how and if, I should say, they violate relevant standards and practices. So as the research continues and reporting requirements develop over time and become more robust, we may update and expand our data collection. But what is clear and what many of you identified through the poll is lack of transparency and voluntary disclosure continues to remain an ongoing challenge. So now let me go into some of the findings in the research. So our research offers countless actionable, compelling insights into the context of rising inequality in the US. So we'd like to highlight a few takeaways. First, of the 1.25 trillion in net profits that the companies assessed, 90% went to shareholders, not back into the organization to support growth, to support innovation and resilience, and not to the employees behind this enormous sum. Just 5% of the companies support a living wage, and not even one has publicly defined what that would look like. Next, what we noticed that the companies that don't pay their workers well typically overcompensate their CEOs. McDonald's, for example, maintains over 1,700:1 ratio of CEO to median employee compensation. Plus, against this backdrop, we noticed that nearly 40 million people in the US, that is 11.5% of the population, live below the poverty line. This is while 6 of the CEOs from the largest 200 companies take home more than 100 million per year. In real terms, this means that 11.5% of people are prevented from reaching their full productive capacity. This hurts communities, this hurts workers, and the broader resilience of the economy. Our findings also indicate that the widening gap in inequality is driven in part by stock buybacks. Companies assessed against our framework recorded showed 63% net profits from a rise of 63% net profits from 2018 to 2022, and stock buybacks reached almost $700 billion. What we noticed is that more and more money is being funneled away from workers that generate the value. For example, the retail sector, which is the most diverse, is the least equitable. While 52% of retail workers are people of color, over 56% are women. And this is all while almost 70% of retail executives are white and over 77% are men. Companies' systemic problems are also exacerbated by ubiquitous corporate tax avoidance. It's particularly rife in tech and pharma sectors where companies chronically pay low taxes, thereby routing money away from low-wage workers and into social programs that protect them. And I think Lebo talked about this as well, like access to good quality education, access to healthcare, etc. Meanwhile, what we noticed is that corporations are also paying lip service to DEI and ESG initiatives, selectively reporting on metrics on the demographics of their workforce and failing to meaningfully disclose or commit to emission targets, I should say. So while 80% we noticed are disclosing workforce demographic data, fewer than half have published DEI-related metric targets, just 11% disclose promotion rates, and 12% share retention rates. Companies' carbon emissions are also increasing. Average Scope 1 and Scope 2 emissions, we noticed, rose by 4% from 2018 to 2022, and many of the companies lack meaningful net zero targets or public just energy transition plans. We also learned that the most diverse industries, particularly retail, also exhibit the largest racial and gender-based pay gaps. Women and people of color earn less on average due to their overrepresentation in low-wage jobs. What's more, while more companies are analyzing their pay gaps, few disclose their findings. What is also, and I think many of you have spoken about, as not revelatory to many of you, is that there are large disclosure gaps, we noticed. Many of the public companies conceal or fail to adequately disclose material information, including pay equity, living wage data, executive diversity, information on offshore subsidiaries, and much more. So yesterday, Oxfam published a blog that captures some of these disclosure gaps. Excuse me. You can access this by clicking the link on the slides. On the same page, there's a suite of other resources that highlights a research report that presents this data, as well as a lot of other data in there that could be useful in your engagement with companies, and a guide to the framework. We've also compiled in-depth profiles looking at 5 companies as well as 3 industries and talking about how they contribute to inequality. You can also access all the data through that link. If you have any questions, I'm over here after the panel or also around over the next few days. Thank you so much for your time.
Thank you very much. I mean, a lot of food for thought there. I'd like to ask you, Lebo, you spoke earlier about the sort of context in South Africa and some of the asset class implications. But when we look at the company level, what are sort of the key ESG issues for you as it relates to inequality?
What are some of the ESG issues?
Key ESG issues for you in relation to inequality.
I'm pausing because at the risk of repeating myself. I think I'll tag on what was shared in terms of what some of the issues that we're also seeing is quality of jobs. So historically, we've looked at employment and is there job creation, but now we are expanding that to the quality of jobs. So when we look at asset allocation and investment managers, we look at the team structure as well, the number of women, not just on the boards, but also investment professionals. So we look at the entire team structure in terms of how many investment professionals, Black, female investment professionals are in the pool, right from analysts all the way up. What is the succession plan within the team? We look at the executive management team and the boards. So we look at gender inclusion from that point of view. So we do that, but also when it comes to investments in manufacturing or economic infrastructure related funds, yes, which really create a lot of job opportunities. Again, there we look at quality of jobs, right? So, when we have a property fund as an example, we say, what are the type of jobs that are being created? Because that's important for economic growth and to actually change economic inequality. So that's something that we do quite extensively.
Interesting. I think one of the other things that Oxfam's research indicates is some of these difficult points for investors where there might be tension between, let's say, returns and the impacts of inequality. We touched on it a little bit before, but there's one thing I picked up in your new roadmap, Sindhu, where you write that investor demand for short-term profits may indirectly depress wages, and investor support for wide-scale corporate tax optimization can impact public revenues that may otherwise be used to reduce a range of systemic risk. Exactly like Shamin said. Can you unpack this a little bit more? What does it mean in practice? How do you actually tackle some of these potential tensions?
Yeah, I mean, it's the most difficult question to answer. There's no very concise way of answering it other than to first say that investors do have a part to play in contributing, and understanding what those contributions are starts, again, I'm going to repeat myself here, with better data, better frameworks, like Charmin's framework, the framework that we put forth, which is a little bit more company-centric itself, and looking at the different functions within a business and tying those to inequality outcomes. So it starts with better data, and then understanding the tools that you have at your disposal. Is it better stewardship, voting policies, proxy voting policies? Is it in our ESG integration process? So, we have a scoring model that we use to assess our entire issuer set. Can we have better social indicators that give our portfolio managers better insight into the social risks posed to their portfolios, to their investments? It's how we control for risk. The minimum safeguards that we have with our responsible business conduct policy, for example, so that we can engage with companies on inequality related issues, and if worse comes to worse, divest appropriately. So there's lots of tools available to investors. That's the one thing we really want to stress in this roadmap, is that this is not an area that is only for governmental, for governments, for academics, or for nonprofits. It's also absolutely a space for investors and companies to get involved, because there are severe economic consequences, as Todd very eloquently pointed out, a drag on the economy, systemic issues, and it matters for individual company performance too. It matters for your reputational risk. It matters for your productivity. And that's one thing we really want to get across in our roadmap, is that this is a financially material issue. Inequality is, from a systemic standpoint on diversified portfolios and at the individual issuer level. That's one thing we really want to stress in this.
Interesting. I'm glad you make that connection with the responsible business conduct side as well, because there's quite a bit of content on the PRI agenda on that, and a lot of attention from investors. But it's not like it's a separate issue. These are interrelated: human rights and inequality, for example, and the tools can be applied across the issues. I think it's the message. Yeah.
I had a question just on the report. Is there a reason you focused on the U.S. only, or is there a plan to look at emerging markets or European companies?
So Oxfam is a confederation, and so for example, Oxfam America only looked at US companies, but I know there are plans to look at different markets and to tweak the indicators based on the market. So for example, I know there's a whole coalition of Oxfam offices in Europe that are going to start looking at different countries and really how do we unpack a lot of these indicators, given the fact that in Europe many the governments provide many social protections that may not be available in the US. The indicators will be tweaked. So,
got it. Awesome.
Yeah, there's plans for that.
Great. And Todd, I'd like to hear your perspectives as well on this research, and perhaps can we, for the benefit of our investors, can we say something about the importance on these various issues? Is there a way to prioritize?
I mean, we're running into a fundamental challenge here, right? The fundamental challenge is that corporations are a construct designed to concentrate wealth. That's what they're supposed to do. You invest in them to get a return. It's not the job of the asset manager or the asset owner to solve inequality. They cannot do that through the redistribution of wealth. The job of the asset manager or the investor is to reduce the risk that their short or medium long-term returns will diminish as a result of inequality. So there's this continuum of, there's some risks that an asset manager like BNP needs to address, right, to reduce their risk. But that is not going to be anywhere close to what society needs to address inequality. The job of that company is to concentrate wealth. So I feel like we just need to disaggregate the conversation a little bit and say, how much can an asset manager or an investor do under the existing incentives, rules, tax policies, etc.? How much then does the government need to create the guidelines that redistribute that a little bit, right? For example, tax disclosure policies, or preventing offshoring of taxes, or to reduce taxes, because then the investment manager can work within those constraints. So there's a second segment, which is the government needs to create constraints to minimize the concentration of wealth, which is the job of that company. And then there's a third, which is that there is some inequality that is systemic in nature because of gender or race inequality. There's structures that have been in place for hundreds of years that it takes us a long time, but have, relatively little to do with returns. They're just structural elements that we're trying to overcome as a society. Don't care if I take your money if you're, a woman or a man. I just want your money. That's not a structural issue. That's a concentration of wealth issue. So then there's this third element, which is how do we address these structural elements of inequality between people? I just feel like we tend to conflate these three, and we somehow think that BNP is going to address all this economic drag, for example. They won't. They're just going to mitigate the risk of specific drags on their portfolio. And if we understand those roles, I feel like it gets much more effective to say, so who is the actor to address that particular problem?
Yeah. No, it's super important point, and I guess it takes us to, if we draw the parallel to the climate change discussion, a lot of the messages now is also signals from investors to governments. This is the regulatory context we need to be able to fill our role as allocators of capital. Can you say something more about what that policy context might look like? You mentioned tax regulation, but what are other? So
what we just need to think of, what are the ways that companies, concentrate wealth? One way is that there's a shareholder class that has the capital to invest, and then I can maximize returns to them. So if you want to change that, you've got to create structures so that there is a broader shareholder class that can invest in the companies, like public equities, for example. That was a great invention in terms of equality. Turns out that private equity is making better returns at the moment. So we need to shift that, and we need to incentivize the IPO process, for example, in the United States, because it's really dried up. Tax policy. It's very profitable to an asset or to an investor if you can offshore your taxes to Ireland. Apologies to Ireland. I don't know if Ireland still does this. But go to some tax haven and just get a lower rate. Governments can prevent that. Investors could say, we don't want you to offshore taxes, but that would be a terrible investment policy because you can save percentages on your returns by letting companies do it. How else do we concentrate? On the board of directors, we tend to focus on people that have shareholder knowledge and their incentives are to protect shareholders. We can restructure that. We can put environment on boards. We can put communities on boards. Europe has dabbled in this through worker committees. That's just one additional stakeholder. You can certainly do those kinds of models for other stakeholders to redistribute the incentives at the board of directors level. The problem at the moment is that investors would look at that board and say, no, thank you very much. These people are meant to be there so that I make less money. So anyway, there are structures that you can put into place. But again, those aren't the structures that an investor should be looking at. they're not incentivized to do it. They will be fired. What they should be looking at is there's a certain set of risks to their returns that happen to be win-win situations to reduce inequality. That's where they should focus, and they'll get 5 or 10% of the problem solved. The other 90% is going to take somebody else.
Do we have any more questions in the audience?
Hi, Lauren Compare, Boston Common. So I love frameworks and I hate frameworks. And actually, I did submit a question, Nikolai.
I don't know why then.
And I'm not technology very literate. So,
could equally be on this side.
So I guess my question to the panel would be, as an investor, how do we sort of embrace this framework of, this set of metrics? And where do we get the most bang for the buck in terms of engagement? Should it be focused on living wage? Should it be focused on tax avoidance? I can't go to a company and engage on all of those KPIs. It's just not it's not effective. So how would you, what advice would you have in terms of which set of issues are going to give us what we need in terms of risk mitigation, but also impact? And I did have the question about, is the investor world just about mitigating risk, or is it also encouraging positive impact?
I want to try to respond to some of what Todd said and maybe answer this at the same time. If we operate in a silo, BNP, I think Todd is completely right about the limitations of our abilities. But I think there's two alignments of incentives. One is with asset owners. So you said you're going to get fired if blah, 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 blah. Well, I've talked to some asset owners this week and since the roadmap has come out, and we're pretty aligned actually. So if pensioners in Canada and who they have representing their moneyed interests are saying these types of risk are what matters and manager selection is based on those criteria, that's a little bit of alignment incentive there. So you won't get fired if you are integrating inequality risk into your investment process. I would say that's one. Two is we're at PRI. We launched the roadmap and we're here at PRI talking about it. Our goal is to get other investors to think in the same way that BNP is on this issue, so that it's analogous to, I think, 15 years ago, the collective action problem with climate action, right? If one manager was going and saying, we're going to do NZAM by ourselves, I don't know what that would look like, or the Paris Agreement was government and one manager or no government. It takes everyone kind of working together on this, and that's just the reality of complex global challenges. So I think if you align incentives between public and private sector and inside the private sector between managers and asset owners, that sort of mitigates, I think, the very valid criticism that Todd was levying against an individual investor acting on their own. In terms of what to engage on and picking the best topic, that's really, really hard. Our stewardship team is constantly thinking about that issue. We talk about in our roadmap an entire section on stewardship, and there's lots of different focus areas that we use. Again, I'm going to go back to using data. I think depending on which issuers you're invested in and their impact in different regions, with better data, you can understand their impact on inequality outcomes. And then only with that data and with that better assessment can you make the determination of this is the focus areas I should focus on for stewardship. Is it a living wage guardrails campaign like Shareholder Commons is doing? Is it engaging on gender equality or wages on the factory floor? You can only do that if you somehow start to understand the impact from a quantitative perspective that those actions, that those policies of the corporation have on inequality outcomes. That's what our framework tries to do. But there's no one-size-fits-all answer for that.
I wasn't criticizing. I'm just saying that there's a reality that it's not the job of an asset manager or an investor to tackle economic inequality beyond financial risk. If you happen to have shareholders or asset owners that are like, yeah, we want you to play with one hand tied behind your back, great, you can go do it. But if your shareholder said, no, I want you to compete against this really low cost over here, that's kind of what you have to do. Yeah.
Sorry. Yeah, I want to challenge this. Sorry, me first. Hi, Margarita Pirovska, I'm PRS Director of Policy. I really like your analysis, but I disagree with the conclusion. So for many years, we've been doing policy research on precisely can investors pursue sustainability outcomes, such as, reducing extreme inequality or addressing climate change. And law firm Freshfields did analysis for us looking at the legal frameworks, and their conclusion is that if an issue like that, like extreme inequality, what the Oxfam colleague showed us, those terrible numbers, are squeezing the future pot of money and future potential financial returns, then an investor should consider what they can do, not only to protect themselves from the risk, which is the usual thing we all know investors should do, but also to tackle the drivers of these future risks. So lawyers tell you, BNP, yes, absolutely, as an individual investor, you can and you should do it, and good on you that you're already considering it. So thank you.
Do I get to play?
You have the floor if you wish to, but
yes, right, of course, it is your job to reduce risk. There's this interesting question of the time horizon, the discount to the risk that a fiduciary can assume. So in some circumstances, an asset manager is actually extremely constrained in their fiduciary duty because of regulation and liability that says you cannot consider any kind of speculative risk. You have to have a very low discount rate because you have to assume that there's no other assumption for your asset owners other than that they want to maximize financial returns. Then there are other fiduciaries that have incredible latitude to take on the fundamentals or the underlying risk or longer term risk. And it turns out that fiduciary duty is constrained based on a number of different factors. So some fiduciaries would look at that risk and say, if I tackle that long-term fundamental challenge, I can make more money, and they can do that. But others, because of the liability and constraints, they actually cannot, even if they saw that benefit in the future. So we're not just working in a purely kind of free market or perfect market condition. We're working amongst regulations, we're working amongst liability, we're working amongst legal constraints. Every fiduciary has a different balancing act to achieve in that. But otherwise.
But I think the message that it's a challenge when we move beyond the win-win scenarios, and we need to recognize that there's a role for policymakers, and I think that's clear. But of course we need to recognize that also investors can send messages to policymakers, as we do often in our work at the PRI, try and facilitate that there is a sort of mutual and constructive conversation between policymakers and investors.
This is I want to play with one hand tied behind my back, so I'm going to petition the referees to say that everyone has to do it. Now we're on a level playing field again.
Leveling the playing field. I think there's, I'm sorry, we're going to go to people who haven't asked questions. Yeah.
Hi, Delaney Gregg from University Pension Plan here in Ontario. And I think I just want to see what the panel, to talk a bit more about, so first of all, we are one of those fiduciaries that have read our role to be that we can deal with inequality as something and that the long-term interest of addressing an issue like this outweighs any marginal costs with its specific investment. But what I wanted to talk about is ask about is why, this issue, maybe more than anything else that PRI deals with, hits at the elephant in the room, right? The financial sector is the source of much of the inequality in the world today. The highest paid executives are in financial companies, and particularly private markets and hedge funds. We are the issue. So how do we get at, we can talk about all of the bringing the bottom up, but the evidence is that inequality is the challenge because of the gap, not because people are being, yes, people are being left behind, that's a problem, but the material issue is the gap at a systemic level. So I'm wondering if we could talk a bit more. I know that Sharan, you mentioned executive CEO pay, but and I think as asset owners, where that gap is less extreme, we do have an opportunity to act on some of those top end challenges. So I was wondering if you could talk a bit more about that aspect.
Shamin, can I invite and I should just say we have about a minute before we need to turn to Sharon. Apologies, it's not a simple question, but please.
I'm happy to also talk to you later on. I mean, I have a lot of thoughts on this, but I think just to sum it up, you know, like Todd and Nikolai have said, like really, you know, engaging with companies, you know, and even as Sindhu talked about, like really looking through your portfolio and really identifying, you know, where to start, how to start, maybe doing sectoral analysis probably is one way to start at it. Another thing is public policy levers. There's so many levers out there in terms of corporate transparency, corporate accountability, and also like recognizing like how can government create an enabling environment to tackle inequality. I mean, the role of government is just going to be very, very key in this endeavor. Yes, and I see we're, you know, at time, so I'm happy to chat with you some more. Yeah.
Can I
Thank you.
add to that? Or
Yeah.
are we out of time?
If you can do it in 30 seconds, I'll
Okay.
allow it.
Okay, I think that as asset owners, we have leverage to influence investment mandates that we give to asset managers. So we can influence that in terms of how much capital is allocated to what in terms of the strategic asset allocation. So we can influence that. But also as active owners, we invest in a large majority of the financial services industry in South Africa and the rest of the continent. And to be active owners in the investments that we've done, right? Influencing the boards, the CEOs, etc., in terms of how they're behaving, you know, internally as well as externally. We have that influence, and it's an onus on us how we use it, right? We need to be active in using the influence and the tools that we have as asset owners, because ultimately we can influence how the environment behaves.
Thank you very much. And appreciate all your questions and how refreshing with a bit of a debate at a responsible investment conference. So I'm delighted now that we can hear from Sharan as well. And she should be up on the screen in a second. Thank you, Sharan, for joining us. I want to also first say thank you for your commitment to the TISFD, and maybe more impressively for joining us at this hour. I believe you joined us from Melbourne. What time is it at where you are?
It's about 2:00.
Oh, there we go. In the night, I should say. So Sharan, you've been listening to our conversation, and with your background spending more than a decade at the International Trade Union Confederation, I would just first of all like to hear your perspective here as well on this debate we're having about the issue of inequality and what are some of the measures we need.
Well, I thought the opening section was brilliant, and it was like music to my ears, because there's no doubt that, you know, you can go back to 2008-9 when the trade union movement raised from our own surveys the increasing decrease in or decline in trust and the inequality and the desperation that was driving that. Indeed, then the OECD actually indicated from their own extensive data research that inequality was a global economic risk in 2009 to 2010. Somewhere in that vicinity, we started to talk about these things. And so even though it's a lot of years since then, to hear the data showing that, you know, this is a major economic risk, as well as, of course, a social disaster for too many people, and the lack of social cohesion or the increasing, fragmentation of social cohesion that's coming from that, increasing into serious conflict, then that was fantastic. I thought the second part of the debate was kind of going back to the future a bit. You know, you had great understanding, but at the same time, there's almost an argument that's not our business, just not our business. Now, I don't believe that. I've worked with the PRI, and I've seen the amazing responsibility that this institution, with its investor members, has taken to put these issues on the table. We talked about them, of course, early on in the form of ESG. That's still very relevant as the foundation. But if environment was the second cousin, then indeed, social issues and standards were in fact almost totally off the menu in terms of any kind of legacy or endowment from corporations. And I thought the last comment about the leverage that investors could have is where we should start, because it is absolutely clear to me that you are not creating a level playing field if the companies that just want to get wealthier and wealthier on the basis of a traditional growth model or a fiduciary model are actually ignoring the fact that where you've got progressive companies taking responsibility for carbon, for nature, and for people, then they are actually facing unfair competition. So what business model will we choose? And my final comment on this would be really a reflection from my previous role and my passions of today. It's workers in terms of pension funds who contribute, I don't know what the latest figure is, but PRI people will know it used to be over $40 trillion to the global investment. And those workers don't want to see their capital used against them. And we talked about patient capital. I remember addressing the PRI over a decade ago about patient capital and looking at how you build a capital base over a working lifetime rather than look at it as a short-term risky measure. So I could go on with history and passion about this, but I think we want to talk about one of the elements that can mitigate this for investors, or, hopefully with investor behaviour, and indeed for companies. But I did want to just recognise that, of course, having led the union campaign for just transition, it was fantastic to hear that put on the table. And if you think about the PRI's role, it was indeed Fiona Reynolds, Nick Robbins, myself and others who conspired to actually raise the petition for investors. And I think then it seemed like a lot of capital, but it was 11 or 12 trillion dollars who signed up to commitment to price in those externalities and act to promote just transitions in a world where indeed the exploitative business model as it changed had nothing to do with any form of social or economic justice. And so we've come a long way. We still haven't got all the answers, but let's say the TISFD will fill a bit of that gap, along with the climate disclosures and the nature disclosures, that if businesses get this right, if investors take responsibility for using their own leverage in terms of conditionality, will make a difference.
And Sharan, on the TISFD, can you talk to us about what the contribution is that we can expect? What is it that investors should be expecting from this initiative?
Well, I think investors have put a lot of time, and I know, asset managers who put a lot of time, as well as companies, and sometimes jointly, into actually looking at how they manage disclosures on climate and now disclosures in nature. The reason I can't be with you is twofold. One, I went to the Clean Energy Ministerial and the G20 energy ministers, who I happen to think are holding a lot of the cards right now in terms of a sustainable future. And I came back to the conference in Sydney, the first ever global Nature Positive Summit. And so there was, in fact, investors, business, people looking at how you drove new models of investment in nature positive outcomes, companies talking about taking responsibility. So this is a too small movement, but it's on the agenda. And of course, the question is, can we make money from indeed mitigating climate disasters and changing business practice around nature? The answer is yes. The answer is yes. But it won't be just the traditional model of big finance. We also have to look at community finance. And I think the TISFD will help fill those gaps. If you're already looking at disclosure on climate and nature, you're already looking at how you not only take responsibility, you not only disclose, but you raise ambition and you make money from it as investors, then let's see what you can do if we built a greater demand economy because people shared wealth, if we built greater resilience because we indeed had got the balance right. And yes, for me, of course, it goes to fundamental labour rights and human rights and wages and working conditions, but it also goes to the question of what's the company dividend? And I want to back in what I'll say about the outcomes that we will deliver. with an example from a company that I think would, not blink when I said it's been a nemesis for trade unions all around the world. But, Vale, out of one of the biggest mining companies from Brazil, biggest global mining companies, in fact, has in fact mapped its inequality footprint. And it's found where it dominates, and often it is the basis of a dominant economic source in many communities. There are 2 million people living below the poverty line. Now, if a company like that can say, we're going to have a target of reducing half of that inequality by X, and look into the ways they can mitigate that with, community engagement, potential dividends around all sorts of measures, including equity ownership in Indigenous lands, then we can see all companies make a difference. So how will the TISFD work? In very simple terms, it is the third arm. If you have carbon disclosure or climate risk, if you have nature and, business still fails to price in externalities for carbon, but they also fail to price in externalities for the very risk they face, because the majority of our GDP is actually based on dependence in nature, and we've taken it for granted. And then the third area is, if we take people for granted and we continue to see the current business model with social disintegration, with the risk of monopoly power growing amok in the global environment, just as we need distribution for supply chains to get the nothing short of an industrial revolution around energy and industrial transition done, then where's the social guarantees? Where's the avoidance of risk? So 2 years. We've got 4 fantastic co-chairs, business with Peter Barker, myself, investors with Amundi, and indeed Gabriel Ramos, long history of looking at inequality through the OECD, and now working in UNESCO. So can I actually indicate that this is a big job? There'll be a steering committee, there's an oversight stewardship group, but there'll be working groups with a technical frame, and we will deliver within 2 years in partnership with the existing bodies of standards and disclosures, i.e. the ISSB, the Europeans, the GRI, etc. We will deliver a set of outcomes that go to a global disclosure framework, guidance and recommendations for business and financial institutions, and education on capacity building resources that are tailored for business and investors, but also for stakeholders to use in what we hope will be increasingly radical partnerships around the existential crisis that we face from climate, nature, and people. And of course, conceptual frameworks that clarify the relationships. So some of the debate you've just had, but underpinned by a body of evidence. And that's where I thought the first part of the debate was fantastic. So it's the missing piece. We've been at it a while on social standards. PRI has been a fantastic ally on this question, but we have actually got global rule of law. What we don't have is indeed investment frameworks and investment practice and business practice that's always conscious of making sure they're not breaking that global rule of law and putting not just planet, but people at the heart of business and economic planning that makes a difference, that stabilizes our world.
Thank you very much, Sharan, for those comments. And we've come to a close here, so please, if I can ask our audience to thank Sharan for joining us here at 2 a.m. in the morning, and our panel, Lebo, Sindhu, Charmaine, and Todd. Thanks very much. And I do just want to remind you, you can give feedback on the app on the sessions. We would love to hear any feedback you have for us, so please take a couple of minutes to do that. And now it's a break.